Talk of our own markets, Nilesh Shetty from Quantum Advisors is now with us on the show. Nilesh, morning. Thank you for joining in. I remember the last conversation you sounded a bit cautious about high valuations, and of course it remains about individual stocks and picking, the stock picking. What is the cash level now? Because last conversation you'd indicated the cash level had gone up to 15%, and any incremental changes that you made to your portfolio?
Cash levels remain around that 15% level. Markets month to date is actually down. So in that sense, it's not moved up for us to trim further. But it is selectively that we are seeing certain names getting there. We continue to believe that entire consumer discretionary space, including automobiles, is now getting expensive by whatever measure you want to sort of gauge valuation. So a lot of our trims are happening in that space. To get a value is very, very difficult in this market, barring, say, that banking and some names in financial space, which has tested people's patience and they're now getting at, say, 2-decade low valuation. But if the markets were to move higher, and incrementally, when you now see it earnings which have come out in Q1, it doesn't warrant anywhere close to the valuations that people are factoring into these companies. So the market has held up surprisingly on flows, domestic flows. Foreign investors have taken money out, but at some point it will turn. And especially in the small and mid-cap space, you need to be very careful because when you're trying to sell, what you assume liquid or what you think there's liquidity when the markets are going up suddenly disappears when the market turns, and the drawdowns can be very sharp.
So autos is the only space where you are pairing positions because it's the valuations have gotten expensive, or any other pockets?
Autos, PSUs for sure. PSUs. We've actually exited a couple of PSUs in the last 1 year. Industrials, we had one name a year ago, which we now don't have any position in industrials because valuations are reminiscent of the 2003 to 2007 bull cycle, while the earnings are nowhere even close. Even the revenue growth is nowhere even close. So getting valuation or getting positions in some of these sectors is very, very tough. So we have zero positions in these sectors actually.
Okay. Are there any sectors that look attractive to you now from both a valuation and a growth standpoint? I mean, for the next 1 year, where do you have your sights set?
The private sector banks by far remain the best value opportunity, but they've tested investors' patience. We thought there was value 2 years ago, and they've not moved much even in the last 2 years. But that remains the only bucket where there is margin of safety in some sense. We have built positions in life insurance. We had a position in a general insurance company which we built a year ago, and a broking company which offers value, provided the legal issue is sorted out there. But apart from that, there is very few places where you find value at the moment.
Nilesh, what about some of these new age tech companies? So for instance, something like Zomato, stock is running up, but it's delivering on growth and on that, improvement in profits. Ola Electric, there is so much optimism baked into the kind of stock price. Pull up something like Unicommerce, the SaaS player. I know it's much smaller. Its market cap must be 2,000-3,000 crore rupees, but Unicommerce is now up also 20%. Its issue price was 108, and now the stock price is at 220, 230. Paytm is also up another 4-5%. What are your thoughts now on new age tech companies and the kind of rally that we've seen?
Yeah, so one is moving from loss to slight profitability, and one is trying to build in extremely high profits and valuation. So there is a big gap there, which we've, at least whatever modeling that we do in these numbers, you have to be very, very optimistic to try to justify any of these valuations. Again, our style is value. We tend to be a lot more conservative when we are buying into companies, try to build in margin of safety. And for us, we are, based on the numbers that we build in for these companies, we don't believe there is margin of safety at the moment in these companies. They were getting their cover maybe a couple of years ago, and valuations had taken a deep dive after IPO. But still, it was like even then you had to be optimistic to buy into these companies. Of course, they've done very well in terms of price, moving higher in terms of share price. But again, it's just moving from marginal or losses to marginal profitability. It's not that they're throwing up billions of dollars of cash flow for investors.
Okay, well, let's do one thing. Let us wrap up on that note. Thanks a lot, Nilesh, for joining in. Appreciate your time here on CNBC TV18. We'll slip into a quick break. On the other side of the break, we'll get you more on the markets and all the top stock updates. Stay tuned.